Today, peak mortgage rate uncertainty, the DFA daily to the 15th of November 2021. Hello again, it's Martin North from Digital Finance Analytics, with the latest post covering finance and property news with a distinctively Australian flavour. In today's post, we consider the complex interest rate environment in which banks have already put up their longer-term fixed-rate mortgage rates, a clear signal of higher rates ahead, yet they're also playing with cheap variable rate loans, which of course could rise if market rates went higher. So, are we at peak mortgage rate uncertainty at the moment? As Australian Broker put it, last week was one of the most active that brokers can remember, with rates chopping and changing across the Big Four. The channels saw lenders hiking fixed rates across the board, slashing variable rates, then hiking again, then slashing again. Since the RBA cash rate decision on Melbourne Cup Day, there have been historic fixed rate movements at all of the Big Four banks, with 50 basis points added to CBA and NAB, 40 at ANZ, and 21 points at Westpac. At the same time, ANZ took 43 points off their variable rate and Westpac took 10 off theirs. It was enough to make brokers sit back and wonder about the last time they had seen such uncertainty in the market. I don't think it's as high as when COVID hit, said Mark Rogan, 20-year industry veteran and mortgage broker with True Savings. Everyone thought, with the threat of jobs, that lending was going to really slow down. In fact, the opposite happened. People kept their jobs, fixed rates dropped dramatically, and people went for it. They got pre-approvals and realised they could borrow more. It's close to being the highest in terms of uncertainty, in terms of people seeing rates rise quickly, and they don't know when that's going to stop, especially when they see CBA raise twice in 3 weeks and other banks follow suit. That's uncertainty around where things will move. There's people out there with pre-approvals hoping to lock in a fixed rate that are now going to miss out because they can't find a property. And there's uncertainty about where things are going to and what's going to do to the market. I wish I had a crystal ball. The background to the uncertainty is the RBA cash rate. While it remains historically low, lenders are now unsure of how long that will continue. The RBA came out and said that they weren't going to put up the cash rate until 2024, and nobody believes them anymore, said Rogan. They also came out and said that they were going to taper their bond buying from $5 billion to $4 billion. I think the banks have seen the bounce back from the first lockdown, are expecting something similar, if not bigger. They're expecting that on the back of that, the easing will happen more quickly, which in itself puts pressure on rates. The cost of funds is increasing, and that's why fixed rates are moving so quickly. Interestingly, a lot of the banks are decreasing their variable rates, some on an LVR basis, which has seen the sub-70s go down, and others on all loans. The Big Four uncertainty, in the short term at least, might well create opportunities for second-tier lenders and non-banks who can operate at the margins, be more agile. Banks are emailing us and telling us about the pressure, said Rogan. They're telling us that they don't know how much longer they can keep fixed rates low. Historically, fixed rates have been 20% and variable rates have been 80% of the market. I've been doing this for 19 years and I've never seen fixed rates so high. Customers tend to avoid them because of issues with break costs. I think they're trading so well because a lot of the rate reductions in the variable rate markets weren't passed on. Where they have been prepared to give something was at the fixed rate market because the RBA was pushing those rates down. And if you lock someone into a fixed rate, they're not going to go. So banks use it to buy market share. There's always people out there who are opportunistic and will possibly take advantage of this, but I don't know how long they'll be able to do it for. It depends on if they're under system. If they've been under system in fixed, they'll have something to hold on to that they can pass on. And things are likely to get even more complex, as Christopher Joy from Kununbar Capital Investments writes. Folks are starting to turn their minds to what life might look like after the end of the RBA's bond purchase program, or quantitative easing. There's a fairly robust consensus that Martin Place will look to accelerate its QE3 taper from $4 billion a week currently to $2 billion a week in February 2022. What few investors appear to understand is that there is a much larger round of long-term quasi-QE4 coming via the banking system, which we currently size at $317 billion, with a range of around $250 to $450 billion starting at the end of June 2021, or $430 billion if we begin at the end of December 2021. That is more bond buying than all the RBA's 3 QE programs combined, which was around $100 billion for QE1 and QE2, and another $102 billion expected for QE3, which will have a profound long-term consequence of asset pricing. Importantly, the mix of asset banks buy is likely to be very different to what the RBA has acquired. Whereas the RBA has split its purchases 80-20 between Commonwealth and state government bonds, the banking system is currently skewed 68-32 in favour of state securities because of the fact that they pay a positive spread above the swap rate, whereas Commonwealth government bonds don't. What is not widely appreciated is that the government bond buying required by the banking system as a result of the banks repaying the RBA the $188 billion they owe under the term funding facility is actually much bigger than the bond buying precipitated by the close of the committed liquidity facility. Estimating the total of HQLA1 shortfall is quite complex and has to account for a range of different factors, including the closure of the CLF by the end of 2022, how quickly the bank system's balance sheets grow, faster growth needed to be funded via debt, and those liabilities generally increase the bank's net cash flows, reducing their LCRs and increasing their demand for high-quality liquid assets. How the bank's balance sheets are funded, because different types of deposits and term attract different net cash outflow assumptions. For example, if retail deposits slow and this money shifts to businesses as households spend their savings, the banks will be hit with a higher net cash flow. And you've also got to make assumptions on flighty business deposits, reducing their LCRs and boosting their demand for, again, high-quality liquid assets. And finally, how quickly banks repay the term funding facility money and the speed with which the RBA tapers its QE program, because faster TFF repayments and a more rapid RBA taper creates the demand for more high-quality liquid asset buying, given there is less cash on deposit at the RBA. Then there is international uncertainty with expectations from the markets for higher rates in the US, based on the shape of the yield curve, which has reacted to embedded inflation fears. Banks are generally hiking borrowing costs for a range of reasons that are worth understanding. The first is that those interest rates were being artificially suppressed by the RBA's suite of cheap money policies. Two particularly potent issues were the term funding facility, under which the RBA lent banks $188 billion at an annual cost of 0.1 to 0.25%, and now the controversial yield curve targeting, which involved the RBA buying 2 to 3 year bonds to keep their yield fixed at around 0.1%. Both policies have now expired, which means the banks have to pay a lot more to borrow 2 to 3 year money to lend to households and businesses. This is why they're boosting their 2 to 3 year fixed interest rates, and they will probably continue doing so until most residential property borrowers are once again using variable rather than fixed rate products. In fact, they are already seeing banks slash variable rates down to 2% while jacking up fixed rates from sub 2 to 2.5% or more. A combination of the RBA lending the banks $188 billion plus a surge in deposit inflows, care of massive fiscal stimulus from the Commonwealth and state governments meant that banks did not need to tap wholesale bond markets as much as they have historically. With the RBA's monies due to be repaid over the next few years and deposit inflows likely to attenuate, banks are normalising their funding needs. As one example, Westpac announced during the week that it expects to issue between $30 and $40 billion of wholesale debt this financial year, with the actual outcome likely to be at the upper end of that range. And Westpac's treasurer, Joe Dawson, sometimes known as the Queen of Credit, wasted no time raising $5.5 billion via an unprecedented 5 simultaneous bond issues in the US markets a few days ago. Following the bank's reporting season, they have updated their modelling of how much wholesale debt they need to issue in 2022, which is currently around $150 billion. That's a touch higher than their average run rate in the 10 years preceding the COVID crisis. One swing factor will be a deposit inflow. If they slow, that number will climb. As investors come to grips with this, they will be normalising the bank's funding costs. The cost of raising 5 years senior debt in Australia has already risen by about 30 basis points over the bank bill swap rate to 60 basis points today. A new 5-year major bank senior deal would probably have to pay around 70 to 75 basis points. With the bank's net interest margins under pressure, they will pass these costs to clients in the form of loftier borrowing rates and or lower deposit returns. Any future financial market shocks will push these funding costs higher, which will only raise the likelihood of unilateral rate hikes from the banking system. And we've seen this time and time again since the global financial crisis. When the RBA calibrates its cash rate settings, it's targeting actual borrowing rates. If banks are lifting borrowing rates outside of any RBA actions, Martin Place will expressly account for them in their own decisioning. A result is that the banking system could easily sideline the RBA for some time, even in the presence of upside surprises on inflation, wages and growth more generally. Another crucial swing factor for the RBA will be the extent to which federal and state governments can work together to accelerate skilled migration to cauterise the mounting labour shortages in certain sectors like retail, restaurants, cafes and agriculture, which are flowing into higher consumer costs. We saw in the October unemployment data an encouraging surge in the number of people looking for work, as represented by the participation rate, which pushed up the jobless rate from 4.6% to 5.2%. As borders rapidly reopen, there's a good chance that a flood of vaccinated skilled migrants will help Australia avoid the demonstrable wage price spirals emerging in the US that are fueling enormous consumer price inflation. During the week, core inflation in the US printed over 4%, which is double what the Federal Reserve is targeting and twice as fast as the underlying inflation that we're experiencing here. Wages growth in the US has been running at about 5 to 6% annualised in the last 6 months, more than double the pace of our wages growth. That's why the RBA has been at pains to stress that Australia's inflation experience is very different from what is playing out in the US. Nonetheless, there are commonalities, including rising energy prices and the ripple effects of the COVID-19 shock, which propagated supply shortages that have pushed up the costs of many items, including building materials and used cars. In the US, rents are soaring as younger folk return to the cities to work, and the labour shortages that are driving higher wages are having second-round impacts on the costs of restaurants, recreation services and household services and daycare. And here we agree with Terry McCrann's argument that there is a stunning cognitive dissonance between the Fed's commitment to targeting 2% core inflation and what it's actually doing. The Fed believes its neutral cash rate is around 2.5%. This is the level of the cash rate that is neither expansionary nor contractionary on the economy. And yet, with a jobless rate of just 4.6% and core inflation doubling the Fed's target, the US cash rate is sitting at just 0.1%. This is impacting long-term estimates of the Fed's cash rate, as represented by the 10-year US government bond yield, which is only 1.55%. The last time the US experienced a much more modest bout of wages growth was in 2018, and then the 10-year yield jumped to 3.2%, which immediately forced US and global equity valuations down by around 20%. The risk for investors is that these long-term interest rates continue to climb back to much more normal levels, which will require a big upward adjustment in the long-term discount rates used to price all asset classes, including listed equities, private equity, commercial property and infrastructure. And given the very high correlation between both long-term Australian and US interest rates and Aussie and US equities, it's entirely possible that the much lower inflation Aussie economy is caught up in the crossfire. And for some bizarre reason, the global equities market appears for the time being to be completely ignorant of these downside risks. Perhaps, as McCrann argues, equity investors are assuming the Fed will always bail them out. As in 2018, they might feel differently when the Fed eventually gets around to hiking its cash rate. House price growth should also cool as our banks start normalising borrowing rates. Crucially, this will likely buy the RBA time to sit on the sidelines for as long as wage growth and inflation remain subdued. The latter will in turn hinge critically on the nation's ability to attract the best and brightest minds to help address our burgeoning labour shortages. Elsewhere, the AFR reported that ANZ has told asset finance brokers it will not accept one-off applications for asset finance applications from December the 1st, putting up to $1 billion in loans each year at risk. The bank has angered commercial brokers by telling them it will only accept deals where a customer already has a relationship with the bank or is open to developing one, adding to the frustrations felt by mortgage brokers over delays in approvals. ANZ has put commercial finance brokers offside with a raft of changes to be implemented next month. In fact, ANZ is behind around 10% of the $30 billion in asset finance written in Australia each year. The Australian Financial Review understands around 25% to 30% of its asset finance business is standalone, or close to $1 billion in lending each year. ANZ's General Manager of Transaction Banking and Asset Finance Solutions, Cosi De Angelis, said the change had not been made because the business was outside of its risk appetite or because it was unhappy with the work brokers were doing. There is no difference in our delinquency positions or in our risk profiling of those loans. We monitor that performance regularly, he said. We want to understand our customers better, and the only way we can do that is that we undertake an appropriate needs analysis before we offer them products. One broker with more than 40 years' experience who did not want to be identified said the bank was becoming impossible to deal with. The turnaround times for approvals cited by the bank did not align with reality. ANZ is under significant pressure because of failures in its mortgage approval process, which has forced the bank to inform brokers in correspondence from the 8th of November that it will take up to 27 days to pick up a file. ANZ CEO Shane Elliott and ANZ Retail and Commercial Banking Executive Mark Hand accepted responsibility for the problems that had seen the bank's home loan book tread water for months when they appeared at the bank's full-year results on October the 28th. Under the changes to asset finance starting on December the 1st, the bank will also insert one of its own business bankers into the relationship between the broker and the customer. The bank says this is not about sidelining brokers, but part of an effort to develop a more in-depth relationship with the customer. The bank will also put an end to brokers and aggregators carrying out Know Your Customer, the KYC requirements, saying it will carry out those processes directly. KYC is a critical component of complying with anti-money laundering and counter-terrorism finance obligations, with deficiencies in the process that rival bank NAB in the spotlight. The decision to take KYC out of the hands of brokers was not a reflection on the brokers or a sign of broader issues at the bank, but merely an attempt to harmonise its processes according to the bank. ANZ conducts KYC for every other product we offer. We are bringing it into house so that it will align with all other ANZ products and businesses, Mr. De Angelis said. The bank will also begin providing more details about how brokers are paid and how that affects the price of the loan being paid by the customer in contract schedules. From December 1, 2021, ANZ Asset Finance customers' contract schedules will contain information about the contract rate, being the sum of the ANZ base interest rate plus an amount that reflects the commission paid to the broker, an email to brokers said. ANZ is confident that changes will not materially hit the size of its asset finance book and expects the attrition rate to be relatively low. It says brokers are already opening transaction accounts for customers in some instances to ensure that they will have the ability to acquire finance when they need it. So standing back, you can see that we're in a complex situation here with a lot of international and local dynamics all pressing into the uncertainty of mortgage rates. But I think that we're going to see considerable uncertainty, not just for the next week or two, but probably for the next year or two. The backcloth here is what the Fed is going to do. And bearing in mind that we think the Fed will raise rates and quite soon, that's going to have a profound impact on the international financial markets. That will put upward pressure on bank funding, and I would expect bank mortgage rates to rise, irrespective of what the RBA does. And as Christopher Joy argued, that means that the RBA can sit on its hands and say, we didn't put the cash rate up till 24, but of course, that's only half the story. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.